Thanks very much for inviting me on such a turnout on a Saturday morning, late morning, but I mean for students it's really early. I appreciate that. If you can't hear me in the back, just wave at me and I try to project a bit better, but I don't have such a good voice. I know we have a problem. What I want to do is talk about, at the request of Sean, a paper that I have published and that is available on the internet in the so-called CES-IFO forum. That is CES-IFO is an economic think tank based in Munich, where Hans-Werner Sinn, some of you may have heard that name, is head of. He actually is somebody who's quite involved in discussions in Germany and unfortunately shapes the discussion there quite a lot. You may notice from my accent that I'm a German too, but I won't give you the dead German view of it. The argument that I make in this paper, which is really about, do we go towards ever closer fiscal union, and of course, in parentheses, the question is always, should we? I'm saying we actually have already a kind of crypto fiscal union through the monetary backbone and through the ECB, and I think David has just alluded to that too. And I briefly go into that. In contrast to what the Eurosceptics always say, and I go into this argument too, it is not that governments kind of always wanted that and then got it. I think it is actually a paradoxical consequence of trying to separate monetary and fiscal policy to the extent we have done. And then when a crisis hits, which came after all from the financial markets, again something that David said, but perhaps it got a bit lost in the seeing all these charts about countries. For example, if you had indexed 2006 all these charts, you would have seen that the US dip was much deeper than the European one because they had a recession a year earlier in Europe. And so when this crisis then hit, you had nothing to relieve the ECB from this task of basically rescuing the financial system, because that is what it was concerned about, and not so much the sovereign debtors. That was just the way how the crisis was fought. Now, I think, like everybody else, this is an undesirable state of affairs. This is not what a central bank should do. It should not be a quasi-fiscal actor. And as you can see, the markets remain fragile, because in the end, when a liquidity crisis turns into a solvency crisis, you do need fiscal resources to solve a solvency crisis, and that is what the central bank cannot do. It could just print. It can technically not go insolvent itself if it takes the losses, because it can always print more money, but obviously that has somewhere the economic limit of hyperinflation. We're nowhere there, but it keeps markets very, very nervous about who is picking up the bill. Nor is it legitimate for any extended period. I mean, to that extent I am German and hawkish on that, because I do think that currency-fiat money is a public good. And it cannot be printed for, basically private purposes. And it is private purposes if you bail out banks on an extended period, or taxpayers in other countries that have never, for which parliaments, the other national parliaments, and the superior authority of tax authorities have never signed up to. Great paper somewhere also on the internet, and where he discusses the monetary policy measures that have been taken with respect to the United States, and argues there that the central bank, the Federal Reserve Bank of the United States, has assumed quasi-fiscal functions. So has the Bank of England, and so has the ECB. We are all in this together, after all. He defines it as saying whenever a central bank basically puts a taxpayer money at risk, equivalent to investing government funds in risky assets. In other words, almost acting like an investment fund. And this is what they do at the moment. Actually, the United States has transgressed that in much more openly than the ECB by even buying commercial paper and directly from private issuers. That is not what the ECB has done, to the same extent being basically becoming a commercial bank in that respect. The two quasi-fiscal functions that the ECB has assumed is, on the one hand, government debt financing. Yes, there is a treaty that prohibits that. That's why the ECB cannot buy in primary markets that is directly from the sovereign issuers of bonds, but it does buy that through the banking system. And it does so quite explicitly, and it has the disadvantage, that is also one with respect to the next one, that it cannot fix, or it has not said, I will, so to speak, intervene until I have a certain yield for these bonds of countries in crisis. So I will intervene and buy these bonds until, say, Spain pays only 4% or 3% above the bond yield of the German Bund. It hasn't said that, and therefore, in a way, it doesn't relieve the sovereign debtor as it could, if it could buy directly from Spain and say, I buy this as a bond at a bond yield of 3%, the price of the bond such that compared to nominal value. It has also engaged in bank recapitalization, because this is, in my view, this is never that they would say that officially, it's all about restoring the monetary transmission mechanism and so on. But in my view, it is doing what the ECB has told governments to do ever since the beginning of the crisis, namely to recapitalize their banking systems. And overstretched fiscal authorities have found that very difficult to do. So the ECB now says, with the long-term refinancing operation, I'll finance you, I'll, so to speak, I finance the bonds at 1% promised interest rate over 3 years. This is a negative real interest rate. And then urge you to buy again bonds, which if the Spanish banks buy Spanish government bonds, they have a yield of about 5, 6, 7%. So this is about kind of a guaranteed margin that the ECB gives these countries, because it also says, I later discount these bonds that you have bought at the discount window of my monetary policy. And so this is what it does. The problem with that kind of bank recapitalization, in contrast to a parliamentary approved program, is that they cannot attach any conditions on it. It must always ask fiscal authorities basically to attach conditionality on it. The central bank so far doesn't do that. And that means, for example, it has no guarantee that this margin between 1% and, say, 6% is actually used for recapitalization and not just paid out in obscene bonuses to bank managers who, for 1 year, think they need a reward for having not crashed their bank. The outright monetary transactions that they have announced, Hans and I had just a little discussion about this. Has Draghi done it? I doubt it, because he has conditioned it on the ESM coming into force and that everybody takes a conditionality program, and governments are reluctant to do that for political reasons we possibly can discuss this afternoon. It is also more of a lender of last resort support. Why it has done the trick is that, in contrast to these other two programs I'm looking at, it has actually said it's unlimited. We do what it takes. And that is already a very stabilizing thing and is key for my argument of why a Eurobond would be much better than what we have with the EFSF and the ESM. But before I go there, let me just address this. When I say, especially if it says I was wondering why they even asked me to write there, because it's usually Germany called the mainstream view of what has to happen. I have to say, when I say the ECB has assumed the quasi-fiscal function, then you have to say in Germany this should not be outlawed and prohibited. Why this is not the Eurosceptics' nightmare come true is because the ECB intervened basically in order to do what any central bank has to do. They need to stabilize the financial system. That is its infrastructure for monetary policy. Without it, it doesn't exist anymore as a policy-making institution. And that forced it to stabilize the bond markets and buy off bonds that it really didn't want to, and into which they had to be pushed kicking and screaming. So in a way, we find also for political economists, interestingly, an institution that actually doesn't want to have all that power, that it is, and the crucial role that is given to us through the crisis. But this fiscal financial feedback loop, I'm sure you have all heard of, and David has spoken about it, when you have the situation that the banks hold a lot of government bonds, that is partly due to a silly regulation that was had to end, namely that it's just every treasury bond of, say, an OECD country that is no longer in the index of emerging markets or whatever the exact criterion is, was under the Basel II rules, had no capital requirements. And so banks were told, this is a safe asset and you can hold it. And so they hold quite a lot of them, and still do, even though we have to say, you know, a Greek bond, we know, is not the same as the Dutch bond. And when then the banks got into trouble and the government had to do a lot of bank bailouts and the economy went into recession, so tax revenues broke down and so on, the quality of these government bonds that were banks were already in trouble and then got even more into trouble because we suddenly see it's not clear whether they get all these bonds, the bonds they hold of governments back, and that pushed them even deeper into trouble, asking the governments again to come in and help them out, and so on and so forth. This is the deadly embrace in which they are, and we need to break that feedback loop. Why the ECB had to go in is because there is no fiscal factor. Exactly as the Eurosceptics, basically in the early on, in the when the ECB was, when the Eurozone was created, always wanted. There must be no joint liability because of all the moral hazard and so on. We have no fiscal actor now, and that pushes the ECB into exactly that situation. And actually, because whenever support is given, the EFSF or the ESM, not only is the support signal to the markets, but also that the market support is limited. And so each time the sums look big, the rates go down, and 24 hours later the banks realize that if, say, Spain or Italy are really in trouble, any of these sums are just too small. And therefore, what we now have is that the whole European system of central banks acts as the risk pool. The instruments have been mentioned, the ELA, where you don't even need a security behind, the target 2 imbalances and so on. But they're all just an expression of, yes, imbalances as underlying drivers, but even without a frozen banking system that unloads all its risks onto the European system of central banks. And actually, when you look into these articles of the ECBS statute, you have a transfer union through that because the losses that any of them would make would be shared among them all. That's not only then true for Ireland and Greece and all that, it's also true for the Germans who keep on exporting and having their export surpluses. If they make losses on these claims against other Eurozone countries, it will be shared among all. And those who should be most angry about this is actually not the Germans, but the French or any such country that have a fairly balanced current account in the medium term. These Eurobond proposals that we then could have, because, as I said, the EFSF, ESM is never enough. And that is something Charles Kindleberger said already when he was discussing in 1973 why the IMF can never play the role that the Federal Reserve Bank did under a functioning Bretton Woods system, because he said any pre-committed amount, as you also have with the IMF, because its donor countries, the guarantor countries, always commit to a certain creation of special drawing rights, and so you always know how much is in the fund. It is a fund, that is exactly the point, in contrast to a budget. Whenever you pre-commit an amount, you tip the hands of the authorities in favor of the speculators. That is almost a quote. And that destabilizes the markets. They will test that pre-committed amount. And that's why we need something that is a kind of open-ended possibility to finance the needs. That doesn't mean this is without limit and, you know, just do whatever it takes, but we can also overdo the moral hazard problem. The moral hazard and stressing moral hazard of governments to the extent that we then ruin the whole thing. The question of a Eurobond, it was actually discussed, and it was even discussed before we had EMU that we need something like a stability mechanism, into which I can't go now, but if you have later questions, I'm happy to respond to that. The Giovannini report in 2000 came out with, you know, should we have something like a government bond, and said, either you create a community institution that has this right to issue these bonds, or you create a single debt instrument behind which all the governments are. Spain never had a fiscal problem. It had a private debt problem that ended up on the government's books, and is now pushed into a bad equilibrium for no reason other than it had a housing bubble, and all economies that get into a crisis through a financial market crisis will have a long and hard slog to get out of it. The Netherlands was mentioned, you know, a strong economy, but will now have to build down and deleverage in a prolonged recession. And this is what hits Spain brutally, and it is pushed ever. It becomes a self-fulfilling prophecy that this country can become insolvent at some point, even though there was no reason for it to be there. That's why I think the national rates cannot be part of a Eurobond proposal. There's a very nifty and much discussed thing from the Bruegel Institute, Delpla, and from Jakob von Weizsäcker, who proposed to do a red and a blue bond. The blue bonds are the good bonds, well, the colors of the European Union, obviously, where up to 60% is under joint liability, and that's a secure asset, while everything above that is your own problem. You know, you are out in the wilderness with that. They almost say we should, with the red bonds, then try to organize an orderly default. For example, you could do that by, that is the idea. I don't want to go into the details of this. And up to that guaranteed quota of 60%, we have a joint liability and then also a joint interest rate. The problem with that is that after this financial crisis since 2007-8, the debt burden is so high and so exorbitant. I mean, we look almost as if we come out of a war. That is probably not enough. And at the moment, we cannot let Greece, even at the beginning, we couldn't even let them default on part of the debt. The country that has 2.5% of GDP, and even though it has a high debt stock, but that was about the volume of its public debt. If we couldn't let Greece then go because we were afraid that the banking system would completely seize up, do you think you can then let Italy default, or let them on their own with the 60% above, allowed 60%, because this is what Italy basically has? So the German Council of Economic Experts comes out with a European debt redemption fund that is now in the new Van Rompuy report to deal with the legacy debt, and said, okay, let's have joint liability for them and have a plan of paying that down in 25 years. Each country must. It can, it basically locates these bonds it has at the moment above 60% with this redemption fund. The redemption fund issues a bond with joint liability and passes on this low interest rate to the sovereign debtors, who must commit to pay that down in a schedule that is shown to them 1% of that debt per year. And so every country can basically, they do calculations within 25 years' time. Even Italy, with the highest repayment need, would be out of the woods and would be within 60%. I come to my last slide. I see the printing. We tried to bring that all together and said, actually, we don't think you should have anything like a guaranteed 60% you can just issue. Why should you? What we really need in the European Union is also an instrument for continuous stabilization policy. the Council of Economic Advisors actually gave us the idea now to say with the legacy that you nearly have to hive that off, because democratically you cannot justify that the parliaments, national parliaments, who have never signed off this debt that was created, should now sign up to deal with it. That must be dealt with separately, and the responsibility is with countries, but yeah, you should pass on this positive externality of low interest rate from the AAA rated countries. Countries, then the Eurogroup would annually agree on what should be the aggregate Euro deficit in line with the monetary policy mix, so that's the policy mix, and then divide up the share. But you have no guarantee that you can live up to your 60% or anything. It will be strictly determined on where are you in the business cycle, what leeway do you have to assume you get, and so on. That would give a continuous incentive those to stay within the rules and play by the rules, because you get a cheap way of refinancing your public debt. And that can be combined with the European semester, where now budgetary plans have to be sent to Brussels before they're discussed in national parliaments. We have that already. But so far it's all about a grand growth plan and stuff like that. While if you would say, we set you the envelope of how much debt you can issue this year under the cheap, joint facility, that would give parliaments an incentive to think twice if they have unsustainable fiscal plans. They could still issue more debt if they want to. You can never prohibit that in a confederation as we are. But in the next round, you would be told, you have overissued last year. I'm afraid we have to deduct that this year. And it would be less a sanction than a positive incentive to stay within the rules, because I don't believe that sovereign countries can be punished ever in the way that the Stability and Growth Pact and all these disciplinarian nightmares really think they can. And you would stop to interfere in this, engage in this micromanagement of budgetary processes, because I think it really undermines the EU's legitimacy. In that sense, I have become actually probably more English than the German. The debt finance outside of the envelope is at your own risk and not usable at the discount window of the ECB. In fact, I would say treasury bonds must then be rated according to private ratings and not guaranteed as a zero capital requirement. So debt markets figuring what is the risk of the sovereign debt they hold. Sorry, I don't have time. Thank you very much.